Hola a todos, el día de hoy tenemos un invitado muy especial. Jonathan Lemko es el jefe de estrategia de inversión de Vanguard. Para quienes no conocen, Vanguard es un manejador de fondos, uno de los más grandes a nivel mundial. Tiene alrededor de 5.1 billones de dólares bajo manejo. Y en esta plática estaremos hablando acerca de las perspectivas de mercado para 2018. Bienvenidos todos. Jonathan, welcome.
Thank you.
Nice,
Pleasure to be here.
nice having you here. Well, regarding the macro perspectives for 2018 and going forward, what are your key themes that you would like to address?
Well, most importantly, we think although there'll be positive growth in much of the world, it's clearly slowing. Developing economies are growing more rapidly, not surprisingly. We're looking at GDP growth in 2018 and 2019 of approximately 5% or so, which is adequate. It's not fantastic, but it's okay. By contrast, we think developed economies will grow at a pace of 2.5, maybe 3, generally speaking. In both cases, we think there'll be very sharp differentiation. So Asia, not surprisingly, will be the fastest growing region of the world. 3 countries in particular, China, India, Indonesia, we expect really solid 6.5 to 7% growth or so. And others, the Malaysias, Singapores, Thailands, Philippines, and so on, adequate growth, somewhere in the 3, 4, maybe 5% range. Not bad, but not quite, say in the case of China, where it was just a few years ago when we saw year after year of 10% plus growth.
Regarding China, there has been a lot saying about hard landing, and which would be the threshold regarding this hard landing?
Typically, economists look at the number 5 number. So 5% or less, generally speaking, is considered a hard landing. At the moment, you'd be hard-pressed to find anybody forecasting that. Instead, if we're talking 6 or 6.5, it's more likely to be a so-called soft landing. Now again, sometimes you can make a case that the numbers that China publishes are suspect. So you have to dig a little bit deeper and look at other factors, like how much energy are they using? How much trucking are they doing, moving goods from one place to another and so on. But when you add up some of those factors, generally speaking, you would come up with a conclusion that seems to indicate that growth will be in the 6 or 6.5% range. So it's not bad. And that in turn is good news for all of emerging markets that sell their commodities to China. Similarly, it's good for Australia, New Zealand, Canada in particular, which sells its commodities to China. As long as China is growing at a decent pace, that helps everybody else in Latin America, Africa, Southeast Asia, parts of Europe. As long as they're buying these commodities, that's pretty good news.
You mentioned India and Indonesia. For starters, those are Asian economies that are growing at a fast pace, and are they under your radar for something good upcoming? Or?
Well, in the case of India, starting from a relatively low base, they've made significant progress under the Prime Minister and the BJP party, meaningful reforms. Now, that isn't to say that India doesn't still have poverty, economic inequality, corruption, all that familiar stuff, but it's less bad than it was. They've made important financial sector changes, they made important governmental changes, all to the good, all market friendly. As a consequence, we've seen Indian interest rate spreads tighten a little bit. We've seen a lot of positive news from that very important country, the second biggest in the world after China. In the case of Indonesia, this has long been an investment grade country, but it's got now very good political and economic leadership, a solid central bank, good fiscal management from their finance ministry, and I would suggest that it is underpriced by the market. Everybody knows China's story in a way. China's fairly valued. That's less true of Indonesia, which is still closely compared to the Philippines in terms of interest rate spreads, and yet it's a better story. So I look to those. The others, the Malaysias, the Philippines, the Singapores, Thailands, and so on, are fine, but they're fairly valued. The market is well aware of their stories right now, I think.
Going down the growth path in other regions of the world, which would be the next after Asian developing?
Well, in emerging markets, I think you would put Central and Eastern Europe next. Hungary, Poland, Romania seem to offer attractive relative value, I think. Their broader economies are reasonably strong. Their politics are becoming increasingly populist, and that should, from an investor perspective, be concerning. But by and large, I think there's still attractive relative value in those countries. Russia, which on the one hand has all new issuance sanctioned in the United States and elsewhere. Its growth is negative, as much as negative 5%. Its economic story is not a good one. It's not a diversified economy beyond petroleum, but it has almost no debt. A really good story, particularly from a fixed income perspective in that regard. And it has political stability. You may like or not like the leadership in the country, but one thing it's hard to argue with is there is very strong political stability in that country. And so from an investor point of view, it's interesting, if you will. And it's not a surprise that at least in the secondary markets, Russia has been performing reasonably well. After that, in the emerging market sector, I would put in Latin America. And here there's a clear bifurcation. On the one hand, you have very strong credits like Chile, Colombia, Peru, Uruguay. But everybody knows these stories as strong, good stories right now. Argentina is clearly deteriorating, and many investors point to Argentina as well as Turkey as the two most problematic countries that are widely owned within the emerging market space. Although the market continues to like the president, Mr. Macri of Argentina, the economy is in bad shape, and I would suggest that the prospects, at least in the short run, are such that it may get worse before it gets better. Venezuela is a kind of there was worries about contagion risk, the problems of Venezuela spreading elsewhere. We haven't seen it. Venezuela, from an investor point of view, has been a disaster, but with the only contagion I can find so far really is the refugees who leave Venezuela to go to Colombia or to Chile. It's a made in Venezuela problem that eventually I think they will default, and then I suspect things will improve, but it gets worse. As cheap as it is, I think it gets worse before it gets better. Brazil, the biggest and most important country in South America, of course, it represents about half the continent. Lately, that is in the last 2 weeks, the market has started to pay attention to at least three factors, and it's giving them concerns. Number one is the elections coming up in the fall. We have 4 viable parties, political parties. None of them seem to be capturing a majority. They're of the left, left of center, and right. I think it'll take up to the election itself before we have a good sense by the second, maybe third round, who the next government party will be. We know that the Bolsonaro and the hard right party seems to be leading at the moment in the polls, but it's early days, and we just don't know how this plays out. I guess the second factor are the trucking strikes that we saw. This was, from an investor point of view, very concerning. Obviously, many goods were not delivered to parts of Brazil. It was tough to get clean water, among other things, to parts of Brazil. This was very, very problematic. And finally, the Lava Jato scandal is mostly, but not entirely complete, I think. And this still seems to move markets from time to time. So taken together, there is, just in the last couple of weeks, some sell-off of Brazilian debt, Brazilian bonds. We'll see how this plays out, but I think we won't see a clear resolution until we have a better sense of who will form the next government. That's my guess at the moment. Finally, Mexico. This is a big deal. From an investor point of view, they look at Mexico's economy and they see relative strength. They see a GDP of 2.5%, maybe 3%. Not great, but not bad. They see decent foreign currency reserves. They see modest inflation. They see unemployment, which continues to decline. They see a reasonably good macroeconomic story. But they're also focused on at least 2 issues as well. One is the upcoming elections on July 1st, and the great uncertainty associated not just with the election on the executive side, but also on the legislative side, and which party will capture the legislature. And separate from that is the whole NAFTA issue. And right now, there's too much uncertainty. We look at the US president and his position on this, and we get mixed signals, to say the least. And so for a combination of those reasons, and we can address any of them if you like in more detail, Mexico at the moment, I see as stable to mildly negative in the short run, but I also believe in the resilience of the Mexican macroeconomy. And I think we have to get past certainly July 1st, which is just 2 weeks away. And then that resilience likely will kick in. Of course, it is unclear who will win the presidency entirely. We follow the polls, we have a sense of it, and so on. But a lot remains to be seen. And furthermore, from a market perspective, we also have to understand that the election may be July 1st, but the new president doesn't take office till December 1st. And that's a long time in our markets. So we'll see.
Regarding here are two issues: the uncertainty regarding the political environment, which should resolve shortly, and the other one regarding trade and NAFTA specifically. Some people wonder if the markets, the foreign exchange, are already pricing in some of this pressure, but focusing on trade and NAFTA, what are your views? What would you expect going forward in this?
All right, best educated guess here is the most likely scenario is nothing gets resolved until 2019 at the earliest, and maybe 2020. And so what happens as a practical matter is the three countries' representatives continue to negotiate, usually behind the scenes. Sometimes politicians will say things that'll make the front page of newspapers, and that might move markets. But the truth is, no meaningful resolution until at least a year, if not longer. My guess is we will see a new NAFTA. It will take a different form. One of the parts, which are very straightforward, is that NAFTA needed an updating anyway. And so we have to acknowledge that the internet existed, something we didn't in the 1990s NAFTA document, that digitalization, technology are all very important, and the implications for trade are vital. That is an easy one, comparatively speaking, in a new NAFTA. The harder ones are, one, what do you do about the sunset clause, which so far the United States seems to insist on, and this from a Canadian and Mexican perspective is not tolerable. Two, what do you the whole issue of a dispute resolution mechanism, which also from especially a Canadian perspective is not negotiable. It must remain, or they claim, and I think they're right, they would walk away. So this is really important, that there's an independent arbiters for disputes, and that has not yet fully been addressed, I think. There are other concerns as well about, broadly speaking, the NAFTA, especially from a Mexican perspective. What do you do about tariffs, especially regarding the auto sector? What do you do about raising compensation for auto workers? How do you do that? What is the compromise there? All of these things the hard things have yet to be addressed, and that's what they'll spend the next year to a year and a half doing, I think. All this is part, I think, of the first, more likely scenario. Second is the so-called skinny NAFTA that's been making much attention in the newspapers of late. And what that means essentially is much of the existing NAFTA would remain in place with some updating, but there'd be some sort of accommodation regarding the auto sector, especially the Mexican auto sector and all that's entailed there. Should they be able to address that one successfully, that could happen relatively soon, because we're not asking for big changes, should that happen. The wild card here is the position of Donald Trump and the United States government, and we just don't know at present how this plays out. The third, and I think the least likely possibility, I give it a 5, maybe 10% chance, so it's not 0, but it's small, is that Donald Trump gives us 6 months notice and says we're pulling out of the NAFTA. And that, I think, is, from an objective point of view, is bad news for everybody, but especially for Mexico and Canada. The United States economy is still largely consumer-driven. Trade matters, but it's of much less consequence than domestic industry. By contrast, Mexico and Canada are export-driven economies. Like it or not, they are far more dependent on the US than is the United States on those two. And so in the absence of a NAFTA, Canada, but particularly Mexico, loses a lot economically. There are some who suggest that if the NAFTA fell apart, well, maybe the old Canada-US deal that was in place before would become the new law of the land, if you will. It's an understanding. The truth is we don't really know because we never tested it. And I don't know if that's true. And if it isn't true, then all three countries would be subject to the World Trade Organization, the WTO, which has no enforcement ability. It's purely a set of guidelines, detailed guidelines, but without any teeth behind them. And we don't know how this plays out. So it is my personal view, because I would stress my employer, Vanguard, has no official view about the NAFTA. This is my personal view. But I hope that we do in fact get a NAFTA agreement. I'd like it to be sooner rather than later, but I suspect it won't. But at least let them keep talking, let them reach a suitable accommodation for all three parties. But I do believe this will take quite some time. Now we have to get through the US elections, the Mexican elections, and then see what else comes up.
Going forward with trade, and here the US taking a stance regarding world trade, and there are not only issues regarding NAFTA renegotiation, but also there have been some measures taken with other countries. What's your view on that?
The United States is reevaluating its trade agreements everywhere. By contrast, Mexico is one of the great world free traders. I think along with Chile and Singapore, maybe South Korea, it has more free trade agreements than any other countries in the world. And they seem to be actively supporting this. But the US right now seems to be retreating, reinvestigating what is perceived to be in the United States' best interest. Donald Trump in particular is driving this, and he feels he wants as much leverage as possible. So the first thing, one of the first, if not the single first thing he did when he became president was pull the United States, or make it clear, the US will have no intention of joining the TPP agreement of some 19 other countries. But that was just the beginning. Again, Donald Trump has predisposed not to have trading activities, he says, one-on-one. He doesn't like multilateral organizations that he feels can gang up on him. And so that's that. But the Republican-controlled Congress may well follow in this regard as well, because they feel they can only get reelected if they follow in his coattails. And we'll know more about this at the elections in November. Okay. So the United States pulled out of the TPP. The United States appears to have a bilateral deal with Korea, but it's not been ratified yet. It could still be subject to change. We may have a deal. We think we do, but we're not 100% sure. All right. The United States is now in a trade dispute with Europe, and particularly Germany, on automobiles. And we don't know how this one plays out. Very uncertain. But the biggest one, by far, that dwarfs everything else, is China. And the United States continues to investigate what its trading relationship should be with China, how to gain the most leverage that it can, how to best address the political and economic change in that country, all of which is also tied into US strategic interests and other interests, which in the past with other presidents may not have been confused with trade, but under Donald Trump seems to be. This is a new one, and this matters because the Chinese and US economies are complementary. They are twinned. There should be an investor recognition that these two countries desperately need each other to succeed. China has well over $3 trillion in reserves. They're not going to sell them because that would reduce their value, presumably. But nonetheless, this is an enormous sum. The United States knows that. And similarly, China wants the U.S. consumer to buy Chinese goods and stuff. The U.S. consumer is a powerful thing, and they buy Chinese things in Walmart and in Target and other stores and so on. China doesn't want that to end. There's a strong trading relationship, a strong investment relationship. There are conflicts, of course, notably on technology transfer, the most sensitive of all. But be that as it may, they need each other to succeed. And right now, there's more uncertainty than usual as President Xi takes on more powers within China with fewer checks on him, and Donald Trump takes certain actions on China that are sometimes unpredictable. There are rumors today that the United States tomorrow, will be Friday the 15th of the month, will impose tariffs on China on certain goods, new tariffs and so on. This is something we'll be watching carefully. So this is a big deal. The main theme here is the United States is reevaluating all of its trading relationships. And more, there's a predisposition to go towards bilateral rather than multilateral trade, because that's where the US seems to feel they have the most leverage. We'll see how all this plays out. It's still early days.
And well, regarding the challenges coming for 2018, which economy do you consider that you should face the most, or which are the main issues for the second half of 2018?
Well, biggest issues in 2018 will, one, be the relative strength of the US and the Chinese economies. Frankly, I think everything else is less important than those two because they're the two biggest economies. One, how well they thrive individually, and two, how well they interact with each other, and in fact support each other in different ways. Or is there new conflict that we should anticipate? That's something we're going to be paying very close attention to. In terms of the broader economies as well, we're going to be paying very close attention to the relative strength of Europe. On the one hand, you have countries starting with Germany, but also the Netherlands and the Nordic countries and Austria, which are thriving, which are doing well by any standard, whether it's GDP or fiscal management, just economic growth and strength. France, the second richest country in Europe, is just stable, but not doing anything much. There's not a lot of dynamism at the moment. The growth is just fair. It's just an adequate story, but not particularly exciting. My concern are the countries that we used to call the so-called pigs countries in 2011, the ones that had terrible deficit problems and that went under so much strain, and in the case of Greece, austerity. They have not resolved those issues, and they include Italy. Italy is the third richest country in Europe. This one matters, and yet their economy is stagnant. Unemployment is growing up slightly. Their banking system, particularly the old historic banks, are problematic. They just elected a populist government comprised of simultaneously the left and the right, which to me tells me it'll be unstable. All of these things combined make me concerned about that credit in particular. Greece is tiny, of course, and has gone through terrible austerity, but we're still not seeing much improvement, much growth, and so on. And maybe we have reason not to expect so much change there. Spain is fair. It's better now than it was in 2011, but they still have an unemployment issue. Growth is okay, but just okay. So taken together, I worry about that part of Europe. Maybe the biggest concern will be next year, not 2018, but in 2019, Brexit becomes an issue. And that's a big deal for the United Kingdom. I think less for the rest of Europe, but for the UK, this will change trade patterns, investment patterns, employment patterns. We don't know yet any specifics about what the final parts of the Brexit deal will be. This is being negotiated as we speak, but we do know, generally speaking, with the United Kingdom not in the Eurozone, this is going to only harm their interests in a lot of ways. And although many investors ask me, is there some chance that they could reverse this, that the Brexit vote could be taken again, and this time it would be a vote against it? The polls are telling us no. The polls are telling us that if a Brexit vote was taken today, it would probably win again. The old cleavages of 2 years ago, old versus young, urban, rural, etc., they remain. And so I suspect we were going to have a Brexit, and again, it's not today's story, but this is going to be next year's story, affecting one of the richest, most powerful countries in the world.
All right. Thank you very much, Jonathan. We have a couple of questions from our social networks, and I would like to address them right now. Sorry for going through this, but let me see. The first one was regarding Mexico's growth, and you already talked about.
Yeah, decent growth, approximately 2.5, maybe as high as 3 for 2018. We'll see. But again, from a macroeconomic point of view, Mexico's doing okay.
Right, and the bilateral trade with the U.S., we already addressed that. Here's another question regarding the investment opportunities in Europe for Italy and Spain. You already mentioned that that it seems that Italy could be a concern.
So what I would recommend is investors take a broad, long-term view of investing anywhere, but including Europe, that they be broadly diversified. So for example, if they own a Europe fund, own as much, market capped, but own a broad European fund, so that there'll always be positive and negative challenges. That's what makes a market. But if you take a long-term perspective and you are broadly diversified, you should be fine.
Regarding emerging markets and the risks that they could represent against tailwind effects, how do you see the emerging markets right now positioned?
From a macroeconomic point of view, I think broadly speaking, most of them are in decent shape. The outliers are the Argentinas and the Turkeys, maybe to some extent the Ukraines, which are clearly problematic. But most of the others are doing reasonably well overall. From a valuation perspective, we've seen a sell-off since the beginning of 2018. This is less from dedicated EM investors, more from crossover investors who are just scared right now because of what they read in Argentina and Turkey, or a sense that the US Fed may continue to raise rates and that poses challenges to EM, or the United States dollar may remain strong, something I share, and that can be concerning as well. But generally speaking, EM has never been as resilient as it is today. Their fiscal performance is very strong, generally speaking, compared to, say, 5 years ago.
I've seen some numbers regarding the buildup of reserves from these countries. How do they stand right now?
Most of the investable ones are, I would characterize, excellent. China's the obvious one, but it's not just China. It's Korea, it's Malaysia in Asia, it's Mexico, it's Brazil. It's countries throughout the emerging market world who learned lessons from a big financial crisis in 97, 98. And one of those lessons was build up a rainy day fund so that when tough times come, you have the reserves in place. In the past, most of those reserves in Latin America or in Asia were United States dollar denominated. That's still mostly, but not entirely true, because increasingly there's diversification to the euro, to yen, and to others. But be that as it may, they protect themselves. And in turn, the credit rating agencies look at that, and they also look at how well these countries manage their debt, and they say, these countries that were junk in 1998 now deserve to be investment grade, and so over time they have continued to upgrade their ratings, which in turn has lowered their borrowing costs. They have the money to pay you back, so that when you buy bonds from these countries, the large majority of investable ones, they will pay you back. It's money good. Plus, because of home bias, they know they have to pay a little premium as well relative to a Mexican corporate if you're a Mexican investor, or a US corporate if you're a US investor. So you get a little more spread, and it's not an accident that EM, until 2018, had been the best performing asset class, be it fixed income or equities. Now, they're going through a tough time now because of broad-based fear that I mentioned, but don't ignore the macroeconomic fundamentals if you are a long-term investor, and that's key here.
All right, well, thank you very much, Jonathan. Nice having you here. Amigos, pues como pueden ver, estas son un poco de las perspectivas que tiene el equipo de Vanguard, el doctor Jonathan Lemko, acerca de la economía yendo hacia adelante. Me quedo con un mensaje muy interesante, casi al cierre, de las lecciones que quedaron para los mercados emergentes. Creo que es una lección que todo el mundo debe tomar en sus finanzas personales. Build up a rainy day fund. It takes time, but it diminishes risk. Entonces, de nuevo, pues gracias por habernos acompañado. Les recuerdo que los ETFs y los fondos indizados de Vanguard están listados también en el SIC. Los pueden adquirir en la Bolsa Mexicana de Valores a través de su plataforma de confianza. Vamos a enviarles una guía o una lista de todos los fondos indizados que están disponibles. Y muchas gracias.